The UK's temporary post-Brexit licensing regime for the financial sector, also known as the temporary permissions regime, was established to allow UK-based financial service providers to continue their activities in the European Union for a transitional period while they applied for and obtained the necessary authorizations under the new regulatory framework. The TPR was intended to provide a smooth transition for both UK and EU firms and to minimize disruptions for customers. The TPR was originally set up to expire on December 31st in 2022. However, the EU extended the TPR for UK firms until December 31st in 2025. The TPR applies to a wide range of financial services activities, and this includes several sectors. One is banking, one is investment services, one is insurance, one is alternative investment funds, and it also includes payment services. UK firms that were authorized to provide regulated services in the EU before the end of the Brexit transition period were eligible for the TPR. UK firms participating in the TPR were required to notify their relevant EU regulator of their intent to participate, and they were required to provide ongoing compliance information to their regulator. And they were also required to apply for the necessary authorizations under the new EU regulatory framework. The TPR has had a significant impact on the UK financial services industry. It has allowed UK firms to maintain their existing customer base in the EU and to continue to provide services to EU clients. However, it has also placed additional burdens on UK firms as they have had to comply with both UK and EU regulations while navigating the complexities of the TPR application process. The TPR is now coming to an end, and UK firms are required to obtain full authorization from their relevant regulators by December 31st in 2025. However, there is still some uncertainty about the future of the UK-EU Financial Services Cooperation. The UK and the EU are currently negotiating a memorandum of understanding on financial services that could provide a more permanent framework for cooperation, although an MOU is not a deal. In the meantime, UK firms will need to carefully plan for their transition out of the TPR, and this will involve reviewing their business models, assessing their compliance obligations, and making the necessary arrangements to apply for full authorization in the EU. The TPR has played a vital role in the transition of the UK financial services industry following Brexit. It has allowed UK firms to maintain their presence in the EU and to continue to serve their client there. However, with the TPR coming to an end, UK firms will now need to focus on obtaining full authorization from their relevant EU regulators. And this will be a complex and challenging task, but it is essential for UK firms to ensure their long-term viability in the EU market. The UK's top financial regulator now has ruled out any extension of its temporary post-Brexit licensing regime beyond the end of this year, vowing to complete work on 116 outstanding cases within the next fortnight. The Financial Conduct Authority announced the temporary permissions regime in 2018, offering companies that had been using their European licenses to passport into the UK a grace period of up to 3 years from Brexit to make other arrangements. FCA Chief Operations Officer Emily Shepherd told the Financial Times that there were 116 companies left on the list of 1,475 banks, insurers, asset managers, and other organizations that originally joined the register, and that all those cases would be dealt with by the end of the year. We as an agency are not extending this regime beyond the end of December, said Shepherd of the approach of the FCA, which faced political backlash for extending a temporary licensing regime for a small number of cryptocurrency companies last year. Companies on the TPR had several options for their future, including running off their businesses over a period of between 5 and 10 years, applying for full authorization in the UK, or moving activities to another fully licensed company within their group. The FCA had warned companies that the TPR was only for those who wanted to operate in the UK in the long term, and said that the UK could remove companies from the regime if they did not meet the FCA standards. And Shepherd said that of the remaining 116 companies, just 3 had live applications for full authorizations with the FCA, while another 6 were still confirming their plans for the end of the regime. Some 80 have told the FCA they are preparing to leave the UK or begin runoff. The remaining 27 are dual regulated by the FCA and the Bank of England's regulatory arm, and their authorization falls under the remit of the Bank of England, which declined to comment to the Financial Times here. Shepherd said that the FCA, which has faced persistent criticism from stakeholders, including the Treasury Select Committee, over the speed of its authorizations, had learned lessons and was now using new practices that give companies better expectations of when decisions will be made. Passporting is a regulatory framework that allows financial services firms authorized in one European Economic Area country to provide their services across the entire EEA without the need for additional authorizations here in the EU, for example. It's an essential element of the single market, enabling firms to operate seamlessly across borders and providing customers with greater choice and flexibility. And until Brexit, the UK was part of it. The passporting regime is based on the principle of mutual recognition, and this means that if a firm is authorized in one EEA country, it's deemed to meet the regulatory requirements for providing its services across the entire EEA. And the home country regulator of the authorized firm is responsible for overseeing its compliance with EEA rules. Passporting offers several benefits for financial services firms and customers alike. For example, firms can avoid the expense and complexity of applying for individual authorizations in each EEA country they wish to operate in. And this can significantly reduce their time to market and allow them to focus on serving their customers. Firms can expand their customer base and reach a wider geographical market without having to establish physical presence in each country. And this can lead to increased revenue and also market share. Passporting allows firms to compete on a level playing field across the EEA, promoting innovation and efficiency in the financial services industry. The UK's departure from the EU has significantly impacted the passporting regime. UK-based firms are no longer able to passport their services into the EU unless they obtain authorization from their relevant EU regulators. And this has led to some firms relocating their operations to the EU or establishing subsidiaries in order to continue serving their EU clients. The future of passporting is uncertain. The UK and the EU, as I said, are currently negotiating a memorandum of understanding on financial services that could provide a more permanent framework for cooperation. If the MOU is agreed, it could allow UK firms to continue passporting their services into the EU under certain conditions. However, this is still a matter of negotiation, and there is no guarantee that an agreement will be reached, and especially none that will just benefit the UK. In the meantime, UK firms need to carefully consider their future plans for operating in the EU market. They should assess their options for obtaining authorization in the EU, consider potential relocation or subsidiary arrangements, and ensure they are compliant with all applicable regulatory requirements. And if you want to know more, the next video is right here in the end screen. I'll see you there. I'll be back.